Good afternoon, everyone. Thanks for coming, and thank you, Red Cloud, for arranging the event so that I can have a chance to introduce to you charity flow-through as well as the traditional flow-through. As a brief background of myself, I'm a trained chartered accountant, most of the time spent in Deloitte in public accounting, and subsequently I went to investment banking for more than 10 years. Around 10 years ago, I still remember as an investment banker when I first looked into the product, charity flow-through. Mind you, there's a difference between the two, charity and traditional flow-through, in which I'll explain to you afterwards. But 10 years ago, when I looked into a charity flow-through product, which is relatively new compared to a traditional flow-through, I looked into the product and it just looked too good to be true. Charity flow-through product is a product where the issuer can get a significant premium. Say, for example, in the province of Quebec, if you put money in a Quebec company, they can get a premium as high as over 50%. And for a charity flow-through provider, PearTree, we will not charge any fees to any of the market participants. Say the issuers, the investment bankers, there are no fees. So trained as a chartered accountant with a professional skepticism in my mind, and look into this thing and say, it sounds too good to be true. And it is this same skepticism that lead to a delayed adoption of charity flow-through as a product. But fast forward to now, when you look into gold majors in the past 3 years, Barrick, Goldcorp, Kinross, when they make investment in junior mining companies, it has become the preferred conduit when they make an investment using charity flow-through, because it will bridge the valuation gap between the buyer and seller, and it will enable a big leverage of the investment, something that I'll walk you through later on. So as you can imagine, with big majors, every time when they adopt a new product, they will do a lot of due diligence work. Barrick, for example, they spend almost a month with the due diligence team, not just legal, but accounting and tax as well, and look into a charity flow-through structure to make sure that everything is solid before going ahead. So fast forward to now, because of the wide adoption from all of the gold majors, in the past 12 years, PearTree concluded over 1.1 billion of charity flow-through transaction. And when you think about the past 3 to 4 years, we concluded 600 million. So this is something that is that is important not to omit in the marketplace, because it's becoming a very popular product. SAP. Oh, there you go. So what is a charity flow-through structure? When you think about a charity flow-through structure, it's a combination of two different parts of the Tax Act. A being the traditional flow-through, and B is tagging in a charity donation structure. Before going into the key benefits, I understand that there are a lot of people in this room who are not familiar with flow-through. So let's walk through what is a traditional flow-through financing. Let's picture a traditional manufacturing company and think about the income statement of those companies. The company will have the revenue, the respective expenses. If you find the difference between the two, you have your net profit, and government in turn will charge tax on these net profit. Scenario is a little bit different for exploration companies, where production doesn't happen yet. If you look into a traditional exploration company, for a good part of the exploration stage, that can be 10 years or even longer, there won't be any revenue. They will have all these expenses, such as drilling expenses, and as a result, there will be no net profit. And to the government, they can't charge any tax to these companies corporately, because there's no net income for these companies for, say, 10 years. And this is why the flow-through share program came in. Mind you, this is the traditional flow-through here. It was first introduced in the country at around the 1950s with some evolution in the product, but overall it has been around for a long time. And what it really does, and why, in case you imagine why is it called a flow-through, it's because of the fact that the government is pretty much allowing these expenses that is otherwise in the corporate level, and the government can't charge tax on it anyways, and allowing these companies to flow through or renounce these expenses to a flow-through investors in the individual hands. So if you look into the equation of flow-through investors, if you invest in the traditional flow-through, the end product is, if you have a taxable income of, let's say, 200,000, and if you invest in 100,000 of a flow-through shares, you will be able to deduct a whole 100%, so 100,000 from your taxable income. So your taxable income in that year will be reduced from 200,000 to 100,000. And as a result, you'll be paying lower tax because of the investment. So this is in simple form what a traditional flow-through is the flowing through of expenses that is otherwise in a tax loss pool in a corporation that cannot be utilized for at least 10 years and flowing through to an individual, allowing them to deduct that in the year when they invest in flow-through shares. Moving on to different types of flow-through shares. A lot of people just know flow-through as the most common form, but there are actually different types of flow-through here. First type is the most common type, CEE, Canadian Exploration Expenses, CDE, Canadian Development Expenses, as well as what we call CERC, Canadian Renewable and Conservation Expenses. Let's set aside CERC for now because this is the least common. In my 10 years plus of experience, there aren't a lot of CERC deal that was done in the marketplace. Most of the time when you see a flow-through deal, it will be under the first category, CEE. And what this does is for determining the existence, location, extent, and quality of a resources. So pretty much using money, and it can be drilling to identify resource package in the ground. And this is typical for a mining company. Majority chunk of the flow-through that is done in mining space is under CEE. And for CEE, if you invest $100,000, the full $100,000, 100% of it can be deducted in the year of investment. CDE, in the mining concept, CDE will include all of those capital expenditures of a mining company, such as, for example, if you have an open pit mine, pre-stripping costs. If you have an underground mine, sinking in a shaft, ramp development, that will be qualified as CDE. On top, all of the oil and gas exploration as well as development expenses will be qualified as CDE. If you asked me these questions maybe 5 years ago for oil and gas company, it can be different because there was a time when the government still allowed a lot of the oil and gas exploration expenses as CEE back then. The problem is when you think about oil and gas, it's a very different industry compared to mining. You can drill in year one. And in year 3, you'll be having production. So the government changed the rule last year. So right now, any type of exploration expenses for oil and gas companies will be categorized as CDE. The major difference between the two, for CDE expenses, if you invest $100,000 in your first year, you can only deduct 30% in the year of investment on a declining balance basis. So if you invest $100,000 first year, you deduct 30. Next year, your CDE pool will be reduced from $100,000 to 70 because you deduct 30,000 the first year. So take 30% of that pool and deduct in the second year, so on and so forth. So that's the biggest difference. When you invest in a flow-through, make sure that you find out whether it's a CEE or CDE because it will make an impact on how much tax you can deduct.
Is it 30% of the original amount, or in the year 2, is it 30% of 70,000?
Well, on declining balance, so first year will be 30% of 100, and second year will be 30% of the 70 because.
Okay, so it's smaller every year.
Yeah. So towards the end, you'll be able to deduct 100% of it.
Okay.
What happens if the mine finds and starts making revenue?
So that would depend on whether if you have other exploration expenses, it would depend on whether it is under the same pit because it will not work if it's under the same pit. If you have a remote area around the pit that is on pure grassroots exploration, that can still be qualified as CEE. But for a lot of the CapEx items for mine development, if you want to further develop the mine, you want to increase the size of the pit, as a result you have additional pre-stripping costs, or if you want to go in further in increasing the depth of the shaft, those will be qualified as CDE.
And if they do find whatever, you, as the investor, benefit from that as well, I imagine. Right?
You would benefit from owning the shares because
Yes,
you would
we own the
expect there to be a
shares.
lift in the shares.
Yeah.
It wouldn't impact your tax
Right,
deduction
anymore.
obviously.
Yeah.
You would still be entitled to the full benefit of the CDE or
Right.
the CEE.
So as the investor, what do you hope that they do?
Well, you hope that
Depends
you
how
get
much they find,
you
I
hope
guess.
that you get the tax write-off and then you get a lift on
I
sort of
see.
a revaluation of the company.
Yeah.
This is the third part of the traditional flow-through. I'm not sure whether the crowd over here have heard of super flow-through. It's a term that is very common. A lot of people talk about super flow-through, but I recognize that a lot of people do not understand the true concept of what is a super flow-through. So regular and super flow-through is a subcategory of CEE really. When you look at CEE, there are two types. Regular is a type, as I mentioned, 100% can be deductible in the year of investment. So if you invest 100,000, 400,000 will be deducted. And super flow through is in addition to the 100% deductibility, the government will allow for additional 15% federal tax credit, what they refer as a mineral exploration tax credit, or METC. In addition, depending on which province you are, you'll get additional provincial tax credit as well. In the case of Ontario, it's additional 5%. So if you invest in, as an Ontario resident, if you invest in a company with a mine in Ontario, in the first year when you make an investment, you will first deduct the 100,000 as mentioned, and federally you can deduct 15%. You'll get a 15% of that 100,000 as a federal tax credit, and provincially you get additional 5% of that 100,000 as an Ontario provincial tax credit. And if you look into the second sheet on a standalone basis, that's something published by PDAC right here. If you look into here, you'll be able to see how the math flows. I'm not going to go through all of the different provinces or territories over here, but if you look in the middle, you see Ontario. So you see so 46% is the combined tax rate. And you can see the 15% down below as a federal tax credit, 5% as an Ontario tax credit. When you factor in all these credits and deduction, each 1,000 of your investment actually will cost you $432. In other words, if you make an investment for $1,000, you will claim roughly $600 in tax return, and you can sell it for around $500 and still make a profit after the 4-month hold period.
So with the highest marginal tax bracket having gone up, your money's even cheaper than the 4%.
Correct.
It's just dated and folks.
Yeah, apologies, because this is the only
it's-
publication they have
yeah.
under PDAC, and they haven't been updating it. But the saving will be bigger.
Yeah.
You can explain PDAC for some of the people that aren't familiar with the mining space as well.
Well, PDAC is a Prospector and Development Association of Canada. So this is one large mining association. And each year when you think about the conference that is held in Toronto around March, this is by far the largest mining conference that is held in the world. And this is the time when you see all of the mining companies from different parts of the world come over to meet with different, whether it be brokers, investment banks, or on the buy side, different portfolio managers. So I just finished the first part of super flow through. And it's important to note that METC, or the Mineral Exploration Tax Credit, is only eligible to individuals. So if you're thinking about one of our clients or yourself having a corporation, Canadian-owned private corporation, you want to use the corporation to subscribe those flow-through shares as a corporate level, the METC will not be eligible to your corporation. And what are the criteria for METC? In order to be eligible for METC, the expenditures must be flow-through mining expenditures that is defined in the Income Tax Act. And what FTME is essentially drilling from the surface, from above the ground. So if you have company that has underground drilling, so you're already down below 200 meters, and this is really drilling from underground, you will not be eligible for the 15%. So another point to note to you, if you make an investment, and if you want to maximize the amount of credit you have, you want to make sure that the company use of proceeds are FTME eligible. And that way you will be able to get the 15%. Another thing is trenching, digging test pits, or bulk sampling. In a general basis, they are not eligible for METC unless it satisfies the two criteria over here down below. And really, they are of too small of a tonnage. And most of the people doing bulk sampling will be far exceeding this amount. And that's why a lot of clients come over to us and say, on the issuer side, I want to issue flow through, but the use of proceeds is for bulk sampling. And most of the time, when you look into the detailed program, it will not be eligible. Before I move forward to charitable flow through, are there any questions on the traditional side of flow through? Okay. If not, I'll move forward to charitable flow through. Once again, charitable flow through is a structure that was designed by PearTree's founder, Ron Birnbaum, around 12 years ago. And what this does is it it stripped out the flow-through tax credit. And when you think about, when you're comparing between a charity flow-through and a traditional flow-through, major difference as an investor yourself is if you invest in a traditional flow-through, as an investor, you retain the tax credit. But if you invest as a participant in a charity flow-through, there won't be any tax credit retained by you. You're pretty much buying common shares, okay? I'll explain the structure over here. Another concept that is important to understand is a delta structure. What a delta for us is defined as how much, what we call as a front end, how much the issuer is receiving versus the back end, how much the investor is getting. So let's say if you're an investor, you put your hand up and say, oh, I want to put in $1 million and I want to buy in just common share, not flow through, buying 1 million of common shares into company ABC who's doing exploration work in Ontario. What we can do as a structuring tool is we can leverage your 1 million up to a delta of 1.4 in Ontario. For every $1 or 1 million you invest, we'll turn that 1 million into 1.4 million. So this is an example over here. Assuming company having shares trading at $1.11, and let's say Red Cloud, they were able to look in the market and say, okay, we identify a group of guys who can buy shares at 10% discount, $1. And let's say if their total size of that $1 is 10 million shares for 10 million. So what we'll do is PearTree on behalf of our donors. So what PearTree does is we have a big book of donors. And our donors include a lot of philanthropists, including top 30 wealthiest families in Canada, where they make multiple million of commitment, donation commitment to different charities in Canada. That will include Sick Kids Hospital, Vancouver General Hospital, et cetera, et cetera. So what we'll do is PearTree, for every $1 you have, PearTree on behalf of donors will pay the issuer 1.4. So these donors will obtain the shares, take those tax credits and deductions as discussed. And later on, when you think about flow-through share, after the tax credits are stripped out, they will become common shares. They will deduct these common shares to a charities of their choice and claim a donation tax credit. And that's why if you remember in the beginning, I mentioned that charity flow-through is a combination of flow-through as well as donation, the two parts of the Income Tax Act. And on the same day, these charities will be selling these shares to the investors identified by Red Cloud at $1. So as you can look into this structure, this is a platform that enables a buyer to have the investment dollars leveraged by 40%. And one significant advantage of this structure is because we have donors over here who take advantage or strip out the tax credit, the ultimate buyer will no longer be just limited to Canadian buyers. They can be international buyers. They can be Australian funds, Asian funds, European funds, US funds. It doesn't matter. And it also fixes one of the shortcomings of a traditional flow-through. Think about the traditional flow-through for a second. Every 1,000 you pay, it really costs you $432. So if you participate in a private placement, you have 4-month hold period. A lot of times, towards the end of the year, a lot of people are buying traditional flow-through for tax planning purposes. And if you're doing that after the 4-month hold period is over, you can sell the stock at 70% of how much you pay, 60% of how much you pay, and you can still make a healthy dollar. And because of that, a lot of times when the company is conducting a traditional flow-through, there will be a lot of selling pressure after the 4-month hold period is over. Using our structure here, and this is why, and this is a major reason why, in addition to the premium, why charity flow-through is gaining a lot of momentum versus traditional flow, is the fact that we can allow strategic shareholders such as Goldcorp, Barrick, Kinross, as mentioned, or international strategic buyers to participate. So if in the back end is a US Global, for example, you would think that they will hold for longer than, you would think that they will hold longer for 4 months. So let's have a recap over here and look into the key benefits.
Is there a hold on these shares? Is that what you're saying? There's no hold on these?
There is no hold in here, but as an ultimate buyer yourself, let's say if you want to, you will have a 4-month.
Discount to what they're actually trading at because of getting it at a cheaper price.
Correct.
There's no hold.
There is a hold period.
There is a hold period.
There's a whole period. But a charity flow-through structure can be done on a prospectus basis. So if Red Cloud determined to do this instead of a private placement, they do a prospectus offering, then there won't be any hold.
And if donors, the donor gets $1.40 in donations?
The dollars, yeah, they will pay. So this is one part I can elaborate as well. So how they will pay at $1.40, and they will donate it at 1. So they will at 1, yeah. Because this is in CRA, in our tax agency, they will perceive fair market value, correct, at $1. So they get a donation tax credit.
At the fair market value.
Correct. And they will also have a capital gain
Yes.
on the $1 as well, because if you buy flow-through share, after you claim the flow-through tax credit, your ACB or your cost base of investment will become 0. So any proceeds you sell afterwards will be fully taxable.
But if I, as the investor, getting it at $1, my ACV is gonna be $1, right, because I'm not getting.
Correct. So if you have a recap, when you look at the recap over here down below, the key benefits to investors such as yourself in participate in this program versus a traditional flow is A, you have a significant leverage. In the Ontario case, 1.4. And if you have Quebec clients who are interested to invest in a company with a project in Quebec, the delta is much higher. It's at 1.65. Or even higher. Say Cisco, for example, this year we did a 68 million of financing, and the delta on Cisco for the Quebec side is at 1.67. So each 1 million is turned into 1.67 million, which is significant leverage. And B is it bridges the valuation gap between the issuer and investors. The very reason why our product is so popular among gold majors is think about it this way. If you run a junior mining company, and if there is a gold major approaching your company, of course you'll be asking them for a premium. Sure, if you want 19.9% of my company stock, pay us a 20% premium. While the gold majors may look into the issuer and say, market has been tough, and why don't you just treat us like a traditional portfolio manager or fund? Give us a 5 to 10% discount. Usually this is the time when it takes a long while before the two parties can come up to an agreement or price to conclude the deal. But if you put in a structure in between as such, the issuer, the junior mining company, will get the 140, so they get the premium. And the investors such as Barrick or Goldcorp, they will pay at $1. They can buy at a discount. So it bridges the valuation gap between the two parties, and it makes everyone happy. The third point over here, this is the same for flow-through as well. When you invest, each 1 million you invest, you will because this is flow-through, and it will be audited by the government to make sure that it's flow-through eligible. All dollars that you invest in, you can make sure that these are legitimate expenses. So you will no longer will you be worrying about CEO spending on expensive meals, wines, first-class flight, because that won't be flow-through eligible. And this is something a portfolio manager mentioned to me. We would like to participate in your structure because it keeps management honest in our proceeds. The fourth point over here is we PearTree, as mentioned, we don't charge any fees to the issuers as well as investment banks because our fee structure came from our donors. When you think about the case of Ontario, as a traditional donation, if you donate 1 million, roughly it will cost you 50% because you get a donation tax credit. So from 1 million to 500,000. If you're doing our structure over here, you buy your flow-through share first, claim the flow-through deduction as well as tax credit, then subsequently donate it and get a donation tax credit. On a combination basis between the two, you reduce your cost of donation from 50% to around 10%. So in other words, as a donor, as a philanthropist, you can donate 5 times as much, and it will cost you the same amount of money. So for PearTree, I find this is a structure where we can get our fees from the donor side as opposed on the issuer side, and that way we can act as a Switzerland of the world, and we'd be friends with everyone on Bay Street. And the final point over here is the very same reason. Depending on your objective, as an investor. If you are an investor, you look into flow through, you say, okay, I just want to take the tax credit. I don't think about holding these stocks for a long run. All I'm thinking is take the credits, 4-month hold period is over, then I sell it. Then this won't be applicable to you. But if you're a long-term shareholder, you say, I really like the story. I want to hold it. It's much better for you to participate in a charitable flow-through structure because your 4-month, after the 4-month hold period is over, you will not have as much of a selling pressure. So these are some of the representative transactions of PearTree. As mentioned, we have concluded over 1.1 billion of transactions. Two of our largest clients, IAMGOLD or Cisco. IAMGOLD is one of the first adopter of our structure, and we have concluded over 100 million with them, over 100 million with Cisco as well. And don't forget that we work on oil and gas as well. We have a Calgary banker over in Calgary working on different oil and gas deals. So Kelt and Nuvista over here, those are some of our clients. And these are some examples of the strategic investments that was made by the majors. And finally, proceed to testimonials. I'll let you read about that. The first one is from Carol Banducci, CFO of IAMGOLD. Second one is Ralph Aldous from US Global. And final testimonial is from Vancouver General Hospital. So in summary, this is a lot of times when I present the structure to people, especially issuer, they focus on 2 points. This is amazing because we get a good premium. This is amazing too because we will not have the selling pressure. But one thing people tend to omit is, I'll let you distribute this out, the philanthropic side of the equation. Because every time when you participate in a charitable flow-through structure, there will be a lot of charities that benefit. As I mentioned, a donor cost of donation will be reduced significantly. As a result, they can donate a lot more. So as a result, as a society, a lot of the charities, they are getting more proceeds of donation because of a structure. Also, companies were able to raise a lot more dollars, which is spent in more deserted area of Canada, as opposed to spending money in welfare where job opportunity is scarce. You'll be able to create a lot more job opportunities in those areas. So every time when you participate in a charity flow-through, think about this aspect of it. And this, what's circling around is, as opposed to a traditional tombstone, after conclusion of the Cisco financing, we prepare something that is a thank you note as we put in the Cisco name up top, as well as our name and all of the charities that were benefited from it. When we present to management, they were very happy about this because this is something that showed the effort in corporate responsibility as well. So I hope you learned something from the session today, and I'll open up the floor for questions.
What's your sort of ratio from like institutional / like major donators versus personal? Like the majors obviously drive the bus, right? And they try and sort of seek out the deal, and then you go to a bunch of, Joe Schlubs to sort of fill in the gaps kind of thing, or tag along with a major deal. Is that sort of...
Sorry, are you referring to the donor side or
the donor side? Yeah.
In the beginning, in the first few years, there are a few of the big donors, but over the years, it's a good mix between the two. Say in the 68 million of donation, for example, don't quote me on the exact number because I work more on the mining side, but I believe it's almost 250 donors for that deal. So as you can tell, there's a good mix between the large donors as well as the smaller donors.
So in looking at the type of investment, we're talking here, like sometimes we talk about the actual opportunity itself, but looking at the other way, what type of investor would be interested, not talking about the donor side, but the buyer side? What type of characteristics of a buyer are you looking for, the firms are looking for, that if I'm having a conversation to talk about, say, hey, there's an opportunity that might interest you? The reason being that some people are speculative, some people like to have, like myself, I like to go something that is, I like blue chip and like to hold.
Right.
Whereas some people are, and that's most of my portfolio is that way.
Right.
And I have other ventures that are much more high risk because I have more hands-on
Right.
more hands-on in it. So how would you define the characteristics of the type of investor that this would attract?
Well, as you can see, because of the very nature of the program, which is to encourage high-risk spending on exploration dollars, you'll find a lot more product on the high-risk side because a lot of them are exploration companies. They are prior to production. Having said that, a producer can also issue flow-through shares. Sometimes you see producer issuing flow-through sharing. If they are doing so, and if you participate in those type of deals, you'll be able to get into a lower risk profile in terms of investments.
Yes, but you're not answering my question, because the question is, what characteristic, like you're talking about the risk profile of the product.
Right.
I'm talking about the profile of like I'm a sales guy. So if I understand who's my buyer, I can talk to my buyer and say, hey, I have this opportunity.
Right.
This will fit your needs. So based on your perspective, because as you stated, you have over $1 billion in transaction history, there should be a common type of characteristic you've seen that would interest that particular buyer, so it makes my life easier to talk to them about this concept.
So to sum it up, whenever there are investors who are interested in any mining companies with a property in Canada, that will be the target. As long as they're willing to put in money in any of those companies with a property in the ground in Canada that has flow-through eligible expenses, those will be the target. If you look into what we do, we usually don't identify the back-end buyers. It's usually the case where either the company do it on a non-brokered basis, they have a few guys approaching them, can be a strategic investor, we want to invest into you, then they call us, sure, we can have a structure that can leverage up your back-end investment dollars. Or they can be a red cloud, they're performing financing with the company, so for every 1 million of book they identify, we turn that book into 1.4. So, and if you think about the trend for the past 12 months, because of the dry up in demand in investment dollars in mining, most of the time you see the back end being strategic investors. Strategic investors as of the gold majors or larger corporations with cash under the balance sheet like Cisco, who are pretty active in investing in the mining space.
So investment bankers might be more interested in this approach than a retail broker talking to his clients, right?
Not necessarily.
Because a traditional flow through is a deeper discount than the discount getting from the charitable flow through, right? Am I not correct in saying that?
Depending on what type of investors you have. As I said, if
They're very concerned about the charitable aspect of it, absolutely. There's a much better.
or if you want to hold the story, if you have a particular investor who are thinking about holding a story for a longer term of time, it's much better for them to pay at a 10% discount, own the common shares, and if they tag along with a Gold Corp as an investor, they will know that Gold Corp will not blow off the share in a 4-month period of time. Yeah. Thank you. Thanks a lot. Appreciate your time. Thank you.